Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing Krispy Kreme stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Let's get started with the model. This is a small cap company, 1.8 billion market cap. They're trading at $11 a share, and they have 169 million shares outstanding. Krispy Kreme makes donuts in the United States, the UK, Ireland, Australia, New Zealand, Mexico, Canada, Japan, etc. They sell donuts in their shops, also grocery stores, convenience stores, quick service restaurants, club memberships, drugstores, and online. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have positive free cash flow in 21 and 22, but negative in 23 in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's negative every single year. Revenue is the sales for the company, and that grows a bit each year from 1.4 billion to 1.7 billion. They do pay a 1.3% dividend, which cost them $24 million. But they have negative free cash flow, so they cannot cover that dividend payment, which means they need to take on debt to pay the dividends. We estimated 4 years of future free cash flows. We also estimated the terminal value of all cash flows past year 4, that's 1.4 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $1.2 billion. We divide that by 169 million shares. And we get a calculated stock price of $7. They're trading at $11, so they're trading at a 47% premium. It's a sell according to the model. There are 12 companies in the same industry as Krispy Kreme, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. They spend $124 million in capex, a little less than the average. I love their ticker, DNUT, short for donut. Their debt to equity ratio is at the median, a little less. They do pay a dividend, although they shouldn't because they have negative free cash flow. They rank 6th in market cap. A good price to book, but we can't look at the PE or price to free cash flow. Negative earnings, negative free cash flow. They have one of the higher price to sales ratios, 1.1. This industry has really low price to sales. They only generate 1.7 billion of revenue, a lot lower than the median average. And we can't look at their 5-year annual revenue growth rate. They have not been public that long. If you bought this stock when they started trading in 2021, you'd be really sad. Look at this chart. It's all red. But it could be a buying opportunity because if you bought it now, it's a much better deal than IPO. It looks like it's trading at its all-time low or pretty close to it. Maybe this point is all-time low. So you'd be down 41% if you bought at IPO. And that's including reinvesting the dividends. Let's look at their income statement. This is for the first quarter of 2024. This is the first quarter of 2023. Revenue went up from 418 million to 442 million. Most of the revenue is from product sales, 433 million. They do make royalty revenue of 9.2 million. Here's a different breakdown of the revenue. Of the 443 million, 420 million is from their company shops, DFD, and branded sweet treats. DFD stands for Delivered Fresh Daily. That includes the other stores that sell their donuts, like McDonald's partner with them. All McDonald's now carry Krispy Kreme donuts, or I think most McDonald's. The company recently announced they ended their branded sweet treats experiment. Here's an article. They announced they're closing their manufacturing plant in North Carolina, the only manufacturing facility that makes their branded sweet treats. They never obtained profitability with this product, so that's why they're gonna exit. Moving forward, the company said it's gonna focus on its fresh business, which is pretty much all its business. That includes donuts people buy in shops, through their app, for delivery, etc. They generated 13 million of mix and equipment revenue from franchisees and 9.2 million from royalties. Of the 442 million of revenue, 295 million is in the US, 125 million international, market development 22 million. They use the term global points of access. These are all the different places you can buy their product. They break it out into 3 segments, US, international, and market development. The most points of access to buy their products are in the US, 7,800. Most of that is from DFD doors. Like there might be 5,000 McDonald's you can buy their products. So that would make up 5,000 of the 7,200 here. 229 hot light theater shops. These are their stores. So if you see the hot light on, then you can just go in and get a donut. They also call their stores fresh shops, 71. And 277 franchisee cookie bakeries. International points of access, 4,800. Most DFD doors, but you also have 490 fresh shops, 16 carts or food trucks. Market development, 2,286. Most of that is DFD doors and fresh shops. Cart, food trucks, and other. When it says other, that's usually a vending machine. An airport would be a common place for a Krispy Kreme vending machine. Let's go back to the income statement. Below revenue is product and distribution cost, 100 million. That's 24% of their revenue. It was 28%, so they're trimming those expenses a lot. The reason for the decrease is due to the exit of the lower margin branded sweet treats business. Also 7.6 million of inventory write-offs and employee severance expenses. Their biggest expense is operating expenses, 205 million. It was 45% of their revenue last year, and now it's 46%. And the increase is mainly due to labor cost inflation and investments to support growth. Below that is SG&A, 72 million, 16% of their revenue. It was 14.7%. That was driven by the investment in their Insomnia cookie business, as well as higher stock-based compensation. This company acquired Insomnia Cookies in 2018. Insomnia sells warm cookies all day and night. They operate in 3 countries with over 250 bakeries. They spent 12 million in marketing, 2.7% of their revenue. 1.1 million in pre-opening costs, 200,000 in other, 34 million in depreciation. Depreciation was driven by higher capital spend and assets that were placed into service to support their stores. That includes the preparation of the McDonald's US rollout. That was a big project. The increase in interest expense was driven by the increase in outstanding debt, also the change in their benchmark interest rates. Operating income is 12 million, last year 15 million, only 2.7% of their revenue, last year 3.6%. They paid 14 million of interest on their debt, 4.3 million of taxes, so net income negative 7 million, last year 1.6 million positive. Here's a calculation of their EPS. Net loss of 8.5 million, shares outstanding 168 million, so a loss per share of 5 cents. They did add some shares. Last year was 168.1 million, so they added about 500,000 shares. Let's look at a statement of cash flows. They had a cash outflow of 18 million in the operating section. Last year was a cash inflow of 10 million. Part of it was due to the negative net income. Also the change in working capital. They had a cash outflow of 50 million. Last year was a cash outflow of 35 million. In their investing section, they spent 29 million of PP&E. Last year, 26 million. Last year, they had a cash inflow of 10 million when they got rid of sweet treats. This section talks a little more about the statement of cash flows, about the changes. We expect to incur additional CapEx related to our accelerated US expansion via QSR channels such as McDonald's. We expect CapEx to be between 7 and 8% of revenues as we deploy the capital efficient hub and spoke model globally. And they expect cash outflows and CapEx to accelerate in 25 and 26. Let's look at their financing section. They had a cash inflow of 180 million from adding debt. They paid back 132 million of debt. A cash inflow of 100 million from structured payables, and then a cash outflow of 97 million. Structured payables is just another way to access credit. Instead of waiting for your customers to pay you, you can get a line of credit with the bank, and they could pay you up front. Of course, you have to pay the bank a fee or an interest rate to do that. It just helps with the timing of cash flows. They paid 6 million of dividends, distribution to shareholders. They bought back 800,000 of their own stock, and they paid 1 million of dividends to their non-controlling interest holders. Let's learn about the history of the company. We have to go way back to 1933 when 18-year-old Vernon Rudolph, along with his brother Louis Rudolph, began working for their uncle, who owned a small journal store in Kentucky. And that store sold a lot of different products, including a really popular donut. That store struggled during the Great Depression. So in 1934, Vernon and his uncle moved to Nashville, Tennessee, hoping for a fresh start. And they focused solely on selling donuts. And the name of the store was the Krispy Kreme Donut Company. And they did spell Krispy Kreme with K in the beginning of each word. The shop did so well that Vernon's father moved to Nashville to help them sell donuts. In 1937, Rudolph opened his own store in North Carolina. He mainly sold products to convenience stores, but he continued to sell hot donuts to individual customers between midnight and 4 a.m. And then in 1939, he opened a Krispy Kreme in Akron, Ohio. He opened a bunch of stores in the 1950s. By the 1960s, Krispy Kreme was known throughout the Southeast. In 1976, Krispy Kreme became a wholly owned subsidiary of Beecher's Foods. In the 1990s, Krispy Kreme had a rapid expansion, opening stores outside the southeastern US. In 2001, they opened their first store in Canada. In April 2000, the company went public on the NASDAQ at $21 a share, ticker KREM. In 2001, they switched to the New York Stock Exchange, and now their ticker was KKD. By 2003, the stock was at $50 a share, a gain of 135% from the IPO. In 2004, they had sales of $660 million, profits of $95 million. That was from 400 stores. In 2004, the company missed quarterly estimates for the first time and suffered their first loss. The company blamed poor results to the low-carb diet craze, blaming the Atkins diet for disappointing earnings. But investors thought this was bullshit because Dunkin' Donuts was not suffering from the low-carb trend. They were doing just as well as prior years. By 2005, the stock was down 80% from weak earnings and also an SEC investigation into the company's alleged improper accounting practices. To avoid bankruptcy, the company started to close unprofitable stores. The company started working with supermarkets and gas stations to carry their donuts. That soon contributed to half their revenue. The other half of their revenue was from their franchisees. A bulk of a franchisor's revenue is from the royalties of their franchisees. Most franchisees pay between 5 and 15% of gross revenue back to the franchisor. Krispy Kreme's royalties were on the really low end, only 4.5%. I owned a Mathnasium franchise, and we had to pay 10% plus 2% for marketing, so 12% off the top. But besides the 4.5% royalty, Krispy Kreme enjoyed significant profits by requiring franchisees to purchase mix and donut making equipment directly from Krispy Kreme. We saw that when we looked at their financials earlier. In 2003, they earned $153 million of revenue from that part of the business, 31% of their revenue. And they were making nice margin on this, a 20% margin, which means they marked everything up 20% at the expense of the franchisee. The rival chain Dunkin' Donuts avoids selling equipment or materials to franchisees. And Krispy Kreme has been accused of channel stuffing by their franchisees. To give you an example of channel stuffing, the franchisees received multiple shipments in the final weeks of a quarter so the headquarters can make their numbers. If Krispy Kreme is going to be short on revenue for the quarter, they'll just ship more products to the franchisees, which means they might ship less in the beginning of the next quarter. In 2009, the SEC issued a cease and desist order telling the company to stop inflating their revenues and engaging in illicit activities. In 2016, JAB Holding Company, a German investment firm, offered $1.35 billion to take the company private. In early 2015, they opened their 1,000th store. In 2018, they acquired bakery chain Insomnia Cookies, which currently operates as a separate entity. We talked about that earlier when we looked at their financials. In 2020, they launched their vending machine business. In July 2021, the company went public once again. The first store to open outside of North America was in Sydney, Australia. The second in the UK. They have stores in Egypt, France, UK, Australia, New Zealand, South Africa, Lebanon, Turkey, India, the DR, Iceland, Ireland, Kuwait, Mexico, Costa Rica, Panama, Russia, Taiwan, South Korea, Malaysia, Thailand, Indonesia, Philippines, Japan, Singapore, Cambodia, Jordan, UAE, Qatar, Saudi Arabia, Bahrain, Hong Kong, Nigeria, Colombia, Ethiopia, and Chile. In 2011, they had 21 stores in Japan. They plan to expand that to 94. In 5 years, they expanded Mexico from 58 to 128. In 2013, they announced the opening of 25 stores in Colombia. That was their first South American country. In 2015, they opened 31 shops in South Africa, their first stores in the continent of Africa. In 2016, they opened a store in Bangladesh, and then by 2020, they exited the country. In 2016, when they were acquired by Jab Beach, each shareholder received $21 in cash. In 2016, they opened their first store in Iceland. In 2017, their first store in Panama. In Guatemala in 2018. In Nigeria in 2018. In Ireland in 2018. And that store in Dublin, Ireland is their most profitable store. Not just most profitable outside the US, most profitable worldwide. They open in Costa Rica in 2023, in Paris, France in 2023, which makes 45,000 donuts per day to appeal to the French customers, including a gingerbread flavored donut. That sounds pretty good. If you want to invest in Krispy Kreme as a franchisee, the minimum is $440,000, but it could go up to $4 million, especially if you add things like a drive-thru. In 2007, they began selling the whole wheat glazed donut to try to appeal to a healthier audience, although it has the same calories as their regular glazed donut. In 2017, the Jelly Belly Jelly Beans donut was announced. In 2019, they released 2 new Reese's branded Chocolate Lovers and Peanut Butter Lovers donuts. In 2020, they launched candy coated donuts with Nerds, jelly beans, sour gummies, and marshmallows. In 2014, they released a $1,700 donut. It was part of a fundraising effort for the Children's Trust. It was covered with 24 karat gold and decorated with edible diamond. The inside was Dom Perignon jelly. In March 2021, they announced they will give a free original glazed donut every day for the rest of the year to customers in the US who prove they had the COVID-19 vaccine. A lot of doctors criticized the move. They said if a person eats a donut every day without making any lifestyle changes, they're gonna gain 15 pounds. So that's the end of the video. Let me know what you think. Please like, subscribe, leave a comment. Thanks for watching.